Listen closely. Right now, Bitcoin is writing a script that will destroy one side of the market. We have a 5-day losing streak snapping, daily momentum screaming strong sell, yet the 1-hour chart is flashing strong buy. That is a textbook trap. And there is one danger zone and one hidden opportunity today. I'm going to show you both, and I'm going to give you 3 exact entry and exit levels you can use now. If you are holding a position, if you are thinking about entering, or if you are already feeling the pain of this chop, stay until the end. Because the 79,000 level, 79,000, decides everything. Most traders will get this wrong. You won't, because we are going to surgically break down the structure, the cross-asset shadow, and the liquidity game that the algos are already playing. Write this number down. Here is the instant market verdict. The session bias is a fade the rally range, with a bearish lean. We are not trending on the daily. We are in a counter-trend bounce inside a strong sell structure. The weekly chart still says buy, so the broad backdrop is not a full-blown collapse yet, but the daily pressure is real. The one invalidation level that proves this bias completely wrong is a 4-hour close above 79,000. That is the line in the sand. Right now, price is 77,263. So we have about $1,700 of upside wiggle room before that structure changes. If Bitcoin prints a 4-hour candle closing above 79,000, the whole daily momentum flips, and suddenly we are talking about a run toward 81,000, maybe even 83,000. Until that happens, I am treating every rally as a potential trap, a liquidity grab before the next leg lower. Write that number down now, 79,000 4-hour close. Put it on your chart. If we break that, everything shifts. I want you to type that number in the comments right now, just 79K 4H close, so I know you're tracking with me. This is the key that unlocks the next massive move. Now let's walk through the charts from the top down, because the big money isn't looking at the 1-minute candle. They are positioned on the weekly, daily, and 4-hour, and that's where your edge lives. Starting with the weekly time frame. The trend is buy. That is not a typo. Despite all the noise, the weekly structure is still intact. The 200-week moving average is not in the data I have in front of me, but more importantly, the 50-week and 100-week averages are sloping higher, and price has been holding above a rising trend line from the lows earlier in the cycle. However, we've had a rejection from the major psychological level of 90,000 a few weeks ago, and now we are in a pullback that hasn't yet broken the weekly swing low. That swing low is way down at 72,500, so there is breathing room. The weekly MACD is still positive but losing momentum, and that often means the big picture is a consolidation, not a bear market. But the weekly chart is a slow-moving beast. It tells you the tide, not the waves, drop down to. The daily, and that's where the urgency kicks in. Daily trend is strong sell. That is the dominant operational time frame. The daily chart is printing lower highs and lower lows. We just had 5 consecutive red days before this little green flicker today. The daily moving averages tell a blunt story. The MA200 is sitting way up at $81,131. That's acting like a brick wall far above. Price is well below it, so structurally, Bitcoin is in a bearish alignment on the daily. The MA20 is at 78,559. The MA10 is at 78,384. Both of those are sloping down. Today's price at 77,263 is below both of them. That means short-term momentum is still negative. The MA5 at 77,735 is just above current price, so we are testing the nearest dynamic resistance. The real battle is the MA50 at 76,450, which is below price, and the MA100 at 76,821, also below price. So Bitcoin is currently sandwiched between the MA50 or MA100 support cluster and the MA5 if MA10 resistance band. That compression is exactly why the next move will be explosive. When you get price coiling between these zones, one side gets slaughtered. The daily MACD is critical here. I have the MACD line reading 401.6, and it's below its signal line. More importantly, it's deeply embedded in bearish territory, but it's starting to flatten. That does not mean buy. That means if bulls don't capitalize soon, the downside momentum will resume with fresh energy. The RSI is at 47.9, right in the middle of the range. No extremes yet, no oversold signal to lean on for a big bounce. This tells me that this bounce could be purely technical short covering, not genuine buying. That's what a liquidity grab looks like. The daily support and resistance numbers I'm working with. Immediate support at 76,199.9, which is just below the MA50 and MA100. If that breaks, the next hard floor is 75,579.5. Below that, we are talking about a run into the mid-74,000s. On the upside, resistance is at 77,412.5 first, then 78,004.7, which aligns nicely with the MA5 and MA10. But the true magnet, the level that all eyes are on, is 79,000. That is the threshold mentioned in the latest institutional flow note. Bitcoin bulls need a 4H close above 79K to shift momentum. That's not just a random number. It's where stops are building and where the daily structure would pivot, now drop to the 4-hour chart. The 4H MACD is showing a slight bullish crossover, early stage, but it's still deeply negative. That means this bounce has energy for a push higher, but it's fragile. The 4H moving averages are still in bearish alignment, with the MA20 acting as resistance around 77,800. That's almost exactly our resistance zone. And here's what most traders miss. The 4H chart is showing a potential inverse head and shoulders pattern if it can get above 79,000, but that pattern fails if we drop back below 76,200. So we have a binary structure. The 1-hour and 5-hour trends are both buy. The 5-hour is buy, the 1-hour is strong buy. That short-term momentum is what's driving this green flicker today. But here's the trap. When lower timeframes are overbought and the daily is strongly bearish, it sets up a perfect bull trap. Liquidity is resting just above the 1-hour highs around 77,400. If we sweep that and then reverse, that's the short of the day. If instead we consolidate and then break above 78,000 with conviction, the short squeeze could catapult us towards 79,000 rapidly. This is why I keep saying the word trap. Both sides think they're right, and the market will hurt the majority. Now let's connect this to the cross-asset shadow. Bitcoin is the risk asset shadow. It doesn't move in isolation. Today, we must talk about the S&P 500 and funding rates. In the last 24 hours, equity futures have been under pressure. The S&P 500 is struggling to hold its own 50-day moving average, and we've seen a bid for the dollar and a sell-off in tech. Normally, Bitcoin would be dragged lower with that. The fact that Bitcoin is edging higher while equities are heavy is either a subtle decoupling or, more likely, a bear trap squeeze before the correlation reasserts. I want you to pull up a chart of the S&P 500 mini futures alongside Bitcoin. You'll see that over the last 2 weeks, the correlation dipped, but then it snapped back violently. We are in one of those windows where a fake divergence lures in counter-trend traders. The smart play is to assume the correlation will reassert until proven otherwise. If the S&P closes below its own critical support, Bitcoin will not stay above 77,000 for long. That's the crosscurrent. The second cross-asset element is funding rates and positioning. I'm looking at perpetual swap funding rates across major exchanges, and they have flipped negative. That means shorts are paying longs. The crowd is heavily net short, expecting continuation of the 5-day losing streak. When funding is negative and the daily is strongly bearish, it feels safe to be short, but that's exactly when the market engineers a short squeeze. The liquidation levels are stacked. There's a thick cluster of short liquidations sitting just above 78,000 and another massive block at 79,000. Market makers know this. A push to 78,400 would trigger a cascade of forced buying, fueling a spike towards 79K. That is the hidden opportunity. But here's the twist. If that squeeze fails to hold, the same liquidations become fuel for the downside when longs get trapped above 77K. This is the liquidity tide coming in and out. And the 1 to 2 week directional lean I have is this. Unless we close the week above 79,000, the daily sell structure will reassert and we will likely retest 75,500 and then 74,000. The exact event that would invalidate that bearish lean is a weekly close above 81,000, back above the 200-day moving average cloud. Until then, the path of least resistance is lower, but with violent counter-trend rallies that punish late shorts. Now here's what most people will do. They'll click away right now, thinking they have the direction. But this is where money is made. I'm about to give you 3 specific trade setups that account for both the trap and the opportunity. Keep watching. And right before that, let's see how aligned we are. Type your Bitcoin range for tomorrow in the comments right now. Give me a high and a low, something like 76,800 to 78,200. I'm reading them. You might spot something I haven't, and I want to see the collective sentiment. This is an interaction mine that sharpens your edge. Alright, trade setups. We'll build these from conservative to aggressive. These are not signals. They are conditional frameworks that require you to manage your own risk. Strategy 1, the sniper, conservative. This setup waits for the structural shift. We are not guessing. The trigger condition, a 4-hour candle close above 79,000. That's it. No chasing before the close. Once that 4-hour candle closes above 79,000, you enter long at market on the next candle's open, but with a limit filter, no more than $10 slippage expected. The entry will be around 79,000 to 79,100. Stop loss goes below the breakout level. We place it at 78,100, which is below the prior resistance turn support and below the MA20. That's a $900 stop. Target 1 is 80,500, which is the next structural resistance and a previous swing high. That gives a risk-reward ratio of 1.6 to 1. Target 2 is 82,000, right near the MA200 in a major supply zone. That's a 3.3 to 1 setup. What voids this conservative long setup? If the 4-hour close happens but then the very next 4-hour candle closes back below 78,500, the breakout is false, and you exit immediately, no questions. This is the highest probability way to catch a trend change without getting trapped by a wick. Now, if you are thinking, that's too patient, I have the active trader setup, strategy 2, the active trader, standard. This one exploits the current range and the liquidity hunt. The entry condition. We wait for a sweep of the resistance at 77,412.5 followed by a sharp rejection and a 15-minute close back below 77,400. That's the liquidity grab false breakout. You go short on that 15-minute close with an entry around 77,350. Stop loss is placed above the wick of that sweep, specifically at 77,800. That's a $450 stop, tight. Because if the momentum continues, we don't want to be short. Target 1 is 76,200, which is the immediate daily support and just below the MA100. That gives a risk-reward of 1 to 2.5. Once target 1 is hit, move your stop to break even. Target 2 is 75,580, the next key support. If price reaches target 2, the total reward is almost 4 times the risk. If instead of a fakeout we get a clean breakout above 77,600 with volume, the active trader flips bias. You then wait for a pullback to the 77,400 level for a long entry. So this strategy has a built-in branch. The condition void is simple. If the 1-hour candle closes above 77,900, the rejection play is off, and you stand aside. This setup thrives on the bearish daily structure while respecting the short-term momentum. And here's something that most traders miss. After target 1 is hit, moving the stop to entry gives you a risk-free runner. I want you to commit to that rule mentally. Type risk-free in the comments if you agree to manage your trades like a professional. That accountability keeps you disciplined. Now the third setup is for those who thrive on high risk, high speed moves. Strategy 3, the aggressor, high risk. This is a momentum chase or counter trend scalp on the 5-minute time frame. The entry condition. We see a swift break below the 1-hour swing low of 76,800 with a 5-minute candle close below it. You go short immediately at market, around 76,750. The stop loss is extremely tight, just above the breakdown level at 77,000. That's a $250 stop. Your target is a quick flush into the 76,200 support, which is a $550 gain, a 2-to-1 risk-reward. You take full profits at 76,200 and do not hold for more. This setup relies on the daily bearish momentum accelerating during a liquidity grab. It fails if price reverses back above 77,000 within the next 15 minutes. Explicit warning. Only for those who know how to lose small and manage risk aggressively. Do not size up on this just because the stop looks small. A few losses in a row on such tight stops can bleed you if you lack discipline. What if the breakout is to the upside? The aggressor can also play the short squeeze. If we see a 5-minute candle close above 77,800 with surging volume, you can go long with a stop at 77,400, targeting 78,800. But I prefer the short side aggressor given the daily strong sell. The squeeze long is counter-trend and much riskier. I will not officially recommend it as a primary setup, but it exists for the nimble risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like CPI or FOMC minutes. Stops are non-negotiable. If you lose 2 trades in a row, step away and reassess. That discipline keeps you alive. Now, let's bring it all together for your next session focus. The one most critical level is still that 79,000 4-hour close. If you see a 4-hour candle close above 79K, the bearish thesis for the immediate term is dead, and you must flip to bullish. Until then, 76,200 is the floor that, if broken, opens the trapdoor to 75,500. Tomorrow we have US jobless claims and more Fed speak that could drive the dollar and risk appetite. I will be back with the full breakdown on that and how it feeds into Bitcoin's next impulse. If you want the full analysis on the S&P 500 and the divergence that's developing there, that video is live now. Tap the end screen. The relationship between BTC and the S&P today is so tight that ignoring it is like trading with one eye closed. Smash the like button if this analysis gave you a clear plan for both the trap and the opportunity. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one, right here, where we turn volatility into profit.